Are you a scaling SaaS founder?
Ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those who don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where 1 + 1 = 7. Because we believe in exponential thinking, or maybe I just misread the calculator. But either way, I'm your host, Jeff Maines. I help B2B SaaS founders like you grow from traction to scale. Here, growth is more than just numbers. It's about crafting a future-proof company, premium valuation, and leaders who build a business of significance while living epic, adventurous lives. Ever feel like you're juggling chainsaws while riding a unicycle on a tightrope? Welcome to the life of a startup founder. Does it have to be that way though? Last weekend I went to an incredible production in Tyler to see a play called Baskerville: A Sherlock Holmes Mystery. And you can probably tell by the name, it was a retelling of the famous Sherlock Holmes story, Hound of the Baskervilles. And with a fair bit of comedy written in, it was brilliantly done. 5 actors pulled off 40 different roles. Of course, you have Holmes and Watson and 3 others who covered darn near everything else. I mean, talk about range. Costume changes, accents, walks, mannerisms. They literally became different people before our eyes. There are even some costume and character changes right in front of the audience, which was brilliant and entertaining. So big shout out to John, Johnny, Haley, Tristan, and Jack. I mean, it was so good. I wish I could take all of you to go see it. And in fact, it was so good, we went back to see it again this last weekend and brought more people with us. It was a masterclass in multitasking. But here's the thing, while it works wonders on stage, in business, it's a recipe for disaster. Trust me, I've been there. Wearing so many hats, I could have opened my own costume shop. Of course, I did it for the same reasons that many of you do, thinking I'm saving money, I can handle it. If I don't do it, then it won't get done right, or done at all. This is just part of the journey, right? Everyone does this. And sure, maybe saving a few bucks now and then, but at what cost? I mean, sanity, family, company's growth, or time. That's the big one. It's the one thing you can never get back. Many founding teams start this way, grinding away, and it works for a while, and then growth grinds to a stop. Let's talk about how to get off this crazy merry-go-round, shall we? First is to recognize the trap of superhero syndrome. We have to address the elephant in the room, right? I mean, the superhero syndrome. We all want to be Tony Stark, building our empire single-handedly, but even Iron Man needed a team. Take a hard look at your daily task. Are you really the best person for each job, or are you clinging on to them out of habit or maybe fear? It's time to be honest with yourself about where you're truly adding value and where you're just spinning your wheels. It's not a one-time thing either. 10 years into my current SaaS company, I still catch myself doing things that someone else should be. We all do them. The problem is that I can do lots of things. They just aren't superpowers. Second is to identify your unique value as a leader. What is your superpower zone of genius? And no, it's not the ability to function on just 2 hours of sleep. What is the one thing you do better than anybody else? Is it strategic planning, maybe product innovation, building client relationships, creating content, right? What do you do that uniquely adds value to the business? And when you don't do it, the business doesn't work as well. Whatever that thing is, that's where you need to be focusing your energy, and everything else, it's time to let it go. Trust me, your business will thank you. And third is to build a team to complement your skills. Revolutionary idea, right? To build a team that complements you. Shocking. Well, this is where 1 + 1 = 7. Look at the gaps in your skill set and in your team. Where are you struggling? Where is your current team overwhelmed? Where are the biggest bottlenecks in your business? The smallest pipes. What are the areas that if they were really flowing would have the greatest impact in your business? I know it's hard to stop and think while you're wearing so many hats, but those are the areas where you need to bring in expertise. And that doesn't always mean hiring full-time employees. Think fractional, contractors, part-timers, or even strategic partnerships. But the goal is to surround yourself with people who excel where you don't. And for me, that's lots of places. But here's the kicker. The real skill of a great leader isn't doing everything. It's knowing what not to do and empowering others to excel. Mind-blowing stuff, I know. And it's something that every leader I know still struggles with, including me. So here's your homework, founders. This week, I want you to identify just one task, just one, that you can hand off to somebody else. And it's not admitting defeat, but it's setting yourself up for victory. Remember, your business needs a CEO, not a super talented actor or a circus performer. It's time to drop those chainsaws, step off the unicycle, and lead. Your future self and your company will thank you. Now, let's go make it happen. Last week was SaaS Pricing Week here on the show. Thursday, we had Pat Megan bringing it home. Pat is Managing Director at Maple Street IGS, where he leads the pricing consulting practice and helps companies leverage customer insights to achieve long-term revenue and profit growth. We talked about value-driven pricing, packaging models, and pricing models that drive expansion, and really smart way to increase pricing so that everybody wins. It was pure genius. And then kicking off SaaS Pricing Week last Tuesday was Bill Wilson, founder and CEO of Pace Pricing. We talked about evolving SaaS pricing models, what's going on in the market, customer value, and overcoming the anxiety of pricing changes. That's a huge one. If you missed either one of those episodes, go back and give them a listen. My guest today is Randy Wootton, a stellar go-to-market executive and CEO of Maxio, where he helps high-growth B2B SaaS companies streamline billing and financial operations. In fact, they are the leading provider of billing and financial operations solutions for high-growth B2B SaaS companies. Maxio is the combination of SaaS Optics and Chargeify, two powerhouse companies. Again, 1 + 1 = 7. With over 20 years of experience, Randy has led transformations at top companies like Percolate, which was acquired by Seismic, Rocket Fuel, a first-generation AI company that he took private, along with leadership roles at Microsoft and Salesforce. Welcome someone who scales SaaS capabilities and drives strategic growth. Randy Wootton. Hey, Randy, welcome to SaaS Fuel.
Hey, thank you very much. Delighted to be here.
Tell me a little bit about your background. You've held leadership roles, Percolate, Rocket Fuel, now Maxio. Share a little bit about your journey in SaaS leadership and what have been some of the most significant learning experiences along the way.
Gosh, well, that leads into quite a story, but let me try to summarize it quickly. When I talk to people, I talk about having basically 3 chapters of my career so far. The first chapter was in the military. I was a bombardier navigator in A6 intruders. I actually went back to the Naval Academy and taught literature for a couple of years. And then that was my first lesson in supply demand. There was a lot of teachers and not a lot of jobs. So I decided I had to go to business. But that was about 10 years. And then the next 15 years, I'd call it the journeyman, working my way through different technology companies, all in SaaS. At the time, we called it web-based ASPs. You may be too young to remember that, but that was my first job, was to take a sort of a monolith on-prem, move it into the cloud and get people to buy it. And so worked at companies, startup companies, early stage digital pioneers like Avenue A, which became Aquata, ultimately bought by Microsoft. I worked at Microsoft for a while, worked at Salesforce. So that's the second part of the career. Third part of the career, as you were alluding to, is the last 9 years I've been in the C-suite in a variety of roles, 3-time CEO, still trying to figure it out. Don't have a helicopter or a yacht. So got lots of things we can talk about, lessons learned. But so far, I've had 3 kind of unique experiences. First one was CEO of a public company called Rocket Fuel that we then took private. Second one was CEO of Percolate, which is a private company backed by Sequoia, GGV, Lightspeed, so a VC type dynamic. And third, with Maxio, is effectively a PE backed. It's Battery Ventures. They do VC, but we're in their majority owned growth equity, which is it's only battery on the board. It's just a very different dynamic than VCs. In addition to that, I've been in a couple of boards of other companies, and so I've been able to see and work with CEOs on both sides of the table.
That is fantastic. So what are the different dynamics? One being venture backed and the other being private equity. What are the differences that you see?
Yeah, so I would say, again, I think it depends on the partners on the board. But I think the number one thing with VC, especially if you've taken multiple stages of investment, multiple rounds of investments, is you have people who have different, they've bought in at different valuations. And so they have different motivations. If you've already made 5x on your money, you might be willing to take a deal that the people that came in the last round aren't going to be able to take because the valuation was too high. So there is a little bit of everyone's nice and friendly until there's a deal on the table you got to agree to take, and then they kind of revert back to their corners, and they're going to try to scrape to make their return for their fund acceptable. I think the other thing, there's a mentality in VCs, because they're often investing in more early stage companies. I would call it like the bet mentality, like they're betting on the horse and the jockey, and they are excited to invest dollars in growth initiatives. I think when PE invests, you primarily have one person who owns the company, so it's a lot more interaction with the management team. So VCs, maybe you're meeting once a quarter as a board team, a full board, and then maybe once a month with each board member as you're giving briefs. With PE firms, everyone that I've talked to in PE, you're meeting weekly. You're meeting weekly with your lead partner. You're probably having monthly reviews, and you're having quarterly deep dives. So it's much more in the kitchen with you as a sous chef. And they're very into the numbers and optimizing for EBITDA, meaning trying to generate cash. And so if you think about VC, the trends are mostly about invest for growth. And a couple of years ago, we would call that growth at all costs, because you're doing market share. The shift and we've seen this in some of the data we'll talk about in a little bit, the shift in the PE market, or in the market more broadly, and the PE specifically, is this idea, well, you need to think more carefully about your growth, and it needs to be efficient growth. And that's where you're seeing things like the rule of 40 come into play and to be more prominent broadly across both VC and PE. But I think PE was always operating from that perspective. So I think the key differences are orientation. And then I think the one I missed was expectation for exit. So PE firms tend to be 3 to 5x. VC firms want 10 to 20% of their portfolio to 10 to 20x. So they're swinging for home runs versus doubles.
Right.
Number 3 would be the way that you interact with the board. Hands on or nose in, nose in, fingers out, or are they really in? And then I think the other is, what is your overall remit? What are you trying to accomplish in the leverage you're going to do that? So it does feel very different.
Yeah, I mean, managing investors, it's a critical part of a CEO's role in a company, especially high growth. When you do have those conflicting expectations or ideas or agendas, how do you handle those, or how do you communicate and manage those investor expectations?
Interesting. Having this perspective, I'll just go back to my rocket fuel days. Is a public company is even radically different, right? Because now you're owned by public shareholders. You have people who are representing shareholders on the board. We only had one of the legacy investors that was still on the board, but I had all these professional board members. You have comp committees. You have all this other. It's a really different dynamic. However, when the company is as we had an inbound offer to buy Rocket Fuel, so you're faced with an acquisition. It is the board which approves moving into the process. And I remember this great advice from a guy who said, Randy, it sounds ridiculous, but what you need to do with the board is go around and find out what is the number that everyone would feel comfortable selling at. Is it 200 million, 400 million, $1 billion? Because if you don't have general agreement in terms of what is the value of the asset, as offers come in or you get into a process and you're creating a bidded type environment, your board can get squirrely. And people say, well, I'm not going to sell unless it's $800 million. And then someone else says, oh, but this is a great deal at 400. So having that conversation around what is the value early as a CEO, and it can change, right? Maybe do it once a year or something. I think what has been interesting with, as I mentioned, with the VCs at Percolate was when we were faced with selling the company, because they were in at different valuations, we did end up struggling with getting to a number that we felt was fair to sell. And I was using that trick to manage that. So going into Maxio, one of the things I wanted to get very clear on was what were the investors' expectations. And I would say for every CEO, doing that once a year, i.e. specifically sitting down with the board and saying, here's the shape of the business that we're growing, looking at our historical growth rate, looking at what's happening in the market. What is a realistic expectation for organic growth from current products? What's a realistic expectation for a Horizon 2 bets? So for products that are coming online this year, what should we expect in terms of revenue from them? And then finally, I think in a PE context where they have like Battery has a big war chest, you want to go out and buy other assets. There's usually an inorganic growth strategy as well. So you put those 3 components together, Fourth component is what should your expectation be in terms of growth from your current customers, either cross-sell, upsell, or pricing monetization changes. And you do that just at the high level for 3 years. And you say, okay, great. If we can get this growth over the next 3 years and we can deliver this sort of savings and efficiencies, you get this sort of EBITDA, then you can have a conversation with the board or talk about what multiples you think are reasonable and saying this exit would be what we're all working towards. Do we all agree? Doing that gives you a great way of framing what the North Star is or what success looks like. And then from that, you can back up to say, okay, well, what do you have to believe to be true next year, year 2, and year 3? Some people will say you need a 5-year plan. I think in companies our stage, we're Series C, Series D, any early stage startup-y type company, 5 years is like a millennium, right? 3 years is probably the most. But anchoring at 3 years and working it back is probably one of my 8 secrets of success. It is one of the most important things to get right, because if you think the growth rate can only be 12% and they're thinking the growth rate needs to be 20%, you're going to be at odds every single meeting.
Right. Yeah, so important that those things are in alignment. It's really, really good advice. I mean, great insights. I mean, you've been in both of those worlds and really have a tremendous grasp on and how to manage that. It's huge. I think a lot of people don't have that perspective.
Well, thank you. And I think one of the things we do, Jeff, with that is we'll talk a little bit more about the Maxio Institute Growth Report. So it is we have about 2,400 customers. From that, we do an enormous amount of analysis. And once a quarter, we publish anonymous data, growth rates across our companies, break it out by size. So at this stage, it's below $1 million and above $1 million. We break it out by industry, so a bunch of industries. We break it out by pricing model, fixed rate versus usage. Why that I bring that up at this point is one of the things I find super helpful as a CEO when you're trying to set expectations around growth assumption is you got to be able to triangulate. Like the investors know more than you do. They see more deals than you do. They see growth rates like Battery, I think, sees something like 5,000 deals a year. They only invest in 20, but they have 5,000 data points a year in terms of what the growth rates are. I don't. I've got one company, me. But because we're Maxio, we do have access to this data. And we anonymize it. We're publishing it. So I'd recommend to any of your listeners that are early stage CEOs, CFOs, go download the report because there's a bunch of information about public companies. But public companies are that's like, major league ball. We're playing double league, triple A ball. And so the growth report will give you some insights, at least a starting point. And by your industry, by your size, is what's been the growth rate. And now I feel like I'm better armed to go in the conversation around, can we achieve 20% growth or should it be 30% growth? What's aggressive, but what's achievable?
Right. And that's so good. And you're absolutely right. I mean, everybody should go download that report because it's absolute gold. I can't believe you don't charge for it. Because there's so much good information in there. I mean, there are a lot of research companies out there that do charge for stuff that's not nearly as good, but it's extremely valuable, and everybody should definitely grab a copy of that.
Well, I mean, Jeff, obviously this is the ad for Maxio, is that part of the way you get that data in terms of understanding what's going on in your own business and ultimately getting the operating metrics that help you understand your growth, your gross retention, your net retention, your LTV to CAC, all of those metrics that when you double click down on your growth rate and say, hey, I want to grow 20%, where's it going to come from? What's the cost, customer acquisition cost for new logos versus the customer acquisition cost for current customers? All that comes from a Maxio system. So we're giving away the thought leadership so that you say, oh gosh, this is great. Now I need a system to help me better understand and run my business.
And just looking at this last report, what are the most surprising or maybe valuable insights that you discovered from the report?
Well, a couple. So one is it feels like growth is normalized. So across our 2,000 customers, we've now seen a couple of quarters of about 15 to 17% growth. So the years of 20, 30% growth over quarter, I think are behind us for all the obvious reasons that we've been talking about, zero interest rates, COVID, et cetera. So I think for B2B SaaS in general, that 15 to 17% is probably a reasonable expectation going forward. Now, that's a lot better than the S&P 500, which analysts say is going to be about 6% this year. And even if you look at the Cloud 150, so the public Cloud 150, what are they growing at? They're growing at 12%. So you are seeing a growth premium in the private companies, and that's, being smaller, being faster. One of the things that was perhaps counterintuitive was that we found that companies that were under $1 million that do a fixed rate pricing, so term subscription, you get paid up front, grow faster than those companies that embrace usage-based pricing at less than $1 million. Now, why is that? I'm not 100% sure, but here's what I would suggest. I think there's a couple of reasons. One is, if you're doing the fixed term contract, you usually get paid up front, meaning you have cash in the bank. If you're an early stage company, cash is oxygen, and your ability to have cash means that you can run faster. I'm going to mix the metaphor, but you can keep going. If you're doing a lot of companies do a PLG model, and it's not synonymous, but they often do a usage-based pay model for that, or pricing model. They're getting paid on a monthly basis. So they can only spend, if they're deliberate and responsible CEOs and CFOs, are only going to spend as much as they can collect. And so the fuel, the oxygen, is a little bit lower. It's not as dependent. Now, if you're the fixed rate, you got to make sure those people renew. You got to be super clear about cash management. I mean, there's a whole set of things in terms of RevRec that become an issue. Again, Maxio can help with that. But I would have thought the growth rate for the early stage companies, for the preponderance of early stage companies that we've seen, are PLG, and that would have lend itself more to a usage-based model. And I would have thought they would have enjoyed higher growth rates, but it's not what we're seeing. Having said that, what you find is, and I think it's about $10 million, I'd have to look at the report, there's this inflection point. The larger companies who have a usage-based model are growing faster than fixed rate. And I think that comes down to the fact that and what we don't have and we're working on is, can we make it MECE, mutually exclusive, collectively exhaustive, meaning we can put all of our companies into either fixed rate only, usage only, or hybrid. We don't have that. What we have is those that primarily have a usage-based model are growing faster. And I think the reason for that, Jeff, is now you have this stable business that is funded through your core product. It's priced by seat. It's an annual contract. You're getting the cash. And now you start to, when you get to that Series B, Series C state, you start to think about value and how do you provide value and capture value. And that lends itself to a usage model where customers are like, look, if I deliver more widgets and you charge me on a price per widget and I'm making more money on a volume-based, usage-based construct, I'm okay paying you for that. And so it's like the cell phone plan. And so I think what you see is you start to get to this value unlock, which then you have alignment between supplier and buyer, and that leads those companies to grow faster at that stage. So what we would say is, it's not either or, it's hybrid. And what you want to understand, and this is where I think a lot of companies, me included, I think one of my big lessons learned coming to Maxio was you have this sense for how do you drive growth. It's usually through new logos or current customers, but there's this whole discipline around monetization, which is pricing and packaging. And how do you think about rolling those out in a disciplined way, which I don't think a lot of CEOs embrace out of the gate.
That's so good. And it's not an all or nothing proposition. It's really figuring out what does that pricing and packaging look like. And I think it does change as the business matures, as even the clients that you're serving are going to change as you continue to get bigger.
Absolutely.
And so making sure that grows along with the company.
Yeah. And I just give you a specific example. So Chargeify, which was one of the two of the legacy companies that Maxio became, Chargeify and SaaS Optics. Chargeify was primarily a billing engine for early stage companies, usage-based pricing models, complexity. So most of our customers on the Chargeify side, call it 1,000, whatever, are in that construct and are monthly pay as you go. SaaS Optics, RevRec and reporting, did some invoicing, but just more in the value in that RevRec and reporting sold to larger companies was term subscription. So we have half of our customers are primarily term and half are usage. And it is absolutely maddening to try to make sense of the data every month and understand, okay, so how has usage grown? Has it contracted, expanded? Because it is a lot of volatility. Some customers, seasonality, they have a lot of usage in December. It drops off in January. If you're counting that as ARR, which most companies will, how do you account for that seasonality? It's just a very different way of accruing for usage, reporting, recognizing the revenue from usage, and then reporting on it so you can understand what's going on in terms of gross retention and net retention by cohort, by segment.
That's really good. And I'm glad you brought up kind of where Maxio came from. So I remember when I first saw the name, I was like, is this a new company? And SaaS Optics, like, of course I know them.
Yeah.
Chargify, of course I know them.
Yeah.
And then we get this new brand Maxio. I was like, oh, that makes sense. And it's such a great combination because each company had so many great strengths in what they did, and you put that together, and it's fantastic.
Well, thank you. It wasn't me. I wasn't smart enough to do that. It was Battery that came with the investment thesis. Primarily, there were two folks, Chelsea Stoner and Dylan Joyce, who had a thesis about the office of the CFO. They've had a couple of big wins in this office, and they saw this potential combination as unlocking enormous value in terms of being able to offer both value to PLG and SLG companies, focus on the B2B SaaS segment. Now, having said that, one of my big lessons learned, and this is for all your early stage founders, CEOs, and CMOs out there, is be careful what you wish for. When you launch a new brand, it's probably harder than you thought. It's going to take longer than you hope. And that comes exactly because of your point that both Chargify and SaaS Optics had been great brands in the market. They'd been around for 12 years, had advocates, fans, etc. And they had very descriptive names. Chargify, like Chargify, well, that must have something to do with charging. SaaS Optics, well, that must have something to do with SaaS operating metrics. Both of them are very descriptive of the product, and there's a lot of brand association you can get from that. And I know this acutely because I've been CEO of companies where their names mean nothing or have no correlation with what they do. Rocket Fuel and Percolate. I had nothing to do with building rockets or fuel, and I had nothing to do with producing coffee. However, they were cool brands. It was kind of the internet thing to have a cool brand. So I show up at Maxio in 2022, or the company in 2022. They had decided to do the rebrand to Maxio. They wouldn't tell me the name. It was like a tighter secret than what was held at Mar-a-Lago. And I had to, embrace it. And don't get me wrong, Jeff. I think the brand team did a wonderful job. I think our brand treatment, Maxio, let's go Maxio, all the swag, like it's really cool. The challenge is people don't know us. And so what we did is we went through that classic transition of where you go SaaS Optics and Chargify becoming Maxio for some period of time. And then you go Maxio, formerly SaaS Optics and Chargify. And then phase 3 is we're just Maxio. We probably went too fast through that journey. And so still today, people like you would say, oh yeah, I've heard of SaaS Optics. I've heard of Chargify, but wait, what's Maxio? So I think as CMOs, they all want to launch a new brand, but I think as CEOs, you want to look at that really closely. And if you're going to do it is, add another zero to the amount of money you're going to have to spend and time you're going to have to spend to make it work. Now, I think over time, will Maxio work? Certainly. That means we can tuck in a lot more products underneath. It's a branded house versus a house of brands. I'm excited about everything else I said in terms of the way they refreshed the brand, the website, the application. So I think the visual representation and the logo is awesome. Just trying to make the connection in potential buyers' minds is still very hard.
Ready to future-proof your company and scale to new heights? Dive into the ultimate resource designed for SaaS founders and C-suite executives. Champion Leadership Group gives you an unfair advantage in scaling up revenue and outwitting competitors. Imagine solving your biggest scaling headaches and hitting 5, 10, 20 million ARR and beyond with ease. We take away the guesswork and the grunt work and replace it with a proven framework supporting you with our on-demand fractional C-suite team, the powerful SaaS Fuel operating system built into software, and a thriving community of fellow scaling founders. Those are the 3 pillars of exponential growth. If you're stuck at your current revenue level, this is your ticket out. Feel like your company is the world's best kept secret? We amplify your success. Now, hey, if you're already crushing it, but too busy to breathe, we got you. We'll free up 20% of your time in the first month, because now is the time to upgrade from traction to scale. If you're ready to work smarter and not just grind harder, schedule a 10-minute growth brainstorm. It's free, and we'll pinpoint the #1 thing blocking revenue. For more, visit championleadership.com. That is where leaders evolve and companies transform. Yeah, it's almost like starting from scratch, building a brand.
It is. And I think that's what people don't realize is the equity in one brand does not necessarily translate to the new brand. Just think about it. A lot of people, they're not in the market for a billing solution every month. So they may have been in the market 3 years ago looking for a billing solution, and now they've grown to a stage. Maybe they were on Stripe. Stripe is a formidable competitor. They're often the default for early stage CEOs to go to. What we find is a lot of our customers migrate from Stripe to us. And 3 years ago, there was no Maxio. So now if they're kind of bumping up against the constraints that Stripe has, and they start looking around, they may say, well, I want to go find Chargeify. We're not advertising Chargeify, or they may have some memory of Chargeify, and it's not being reinforced through ABM. It's not being reinforced through brand awareness campaigns. So it is, to your point, building a new brand in the mind of the buyer again and again and again.
Yeah. Well, Maxio does focus billing, financial operations, specifically high growth SaaS.
Yeah.
What are some common challenges you see companies facing when it comes to billing and invoicing?
Well,
I think those are places where we get into a lot of trouble if we're not careful.
Yes, I would say I'll give you one point and then one personal story. So number one, I didn't realize this, but if you look at the industry experts, they say about 7 to 9% of B2B SaaS companies, B2B SaaS companies on average lose 7 to 9% of revenue due to billing issues. This means that they either didn't issue the invoice, the invoice was wrong, or the customer's contesting it. So that means
we made all those mistakes.
Okay. Well, let's talk about Maxio.
That's a tough one. When you go, what do you mean we didn't bill them?
Right.
For 3 years.
We didn't even bill them. We didn't even bill them. That's the thing that's mind-boggling to me is you've done all this work to acquire the customer, get them up and running. Think about all the dollars you spent on commissions, on your implementation team, your adoption team. And then if they fall off the radar, you don't go through a renewal motion. They don't get the renewal in a timely manner, and they contest it and say, well, you should have billed me, whatever. I'm not going to pay this.
Yeah.
And then you spend all that money on collections. So the ability to improve, which we also offer is collections and payments, to streamline those financial operations. So you get them up, you acquire them, you provision them, you set them up, you invoice them, you bill them, or they can interact with the billing portal, and then you collect the payments. Like tightening that loop solves the primary issue of the revenue leakage, what we call revenue leakage. The other thing I think you find is that a lot of people are running complicated businesses with spreadsheets, and they just brute force it with people. And so CFOs build their careers based on their modeling capabilities. And so they want to be able to model. Every company I've been in, every CFO who comes in and says, oh, your old model sucks. I'm going to start over. And they spend a month building their model, their business model. And they need to do that in some ways because they're accountable for, down to the penny in terms of what's happening in primarily cash. They got to know what's going on with cash. To get the cash, it seems so simple, but you have all of these other inputs you got to do. And so they build a model. Now, as you get bigger and you have lots of customers and you've got this deferred revenue thing and you got, all these other impacts to how you think about cash flowing through the system from order to cash, it can get super complicated and takes a lot of people. So brute force. So the other area of value that Maxio offers is you automate that. It's workflow automation. So my CFO, who's been CFO multiple times, he's also worked at Vista and Marlin, two great PE firms, would say as a data point, for our size company, he would need 11 or 12 people in finance. We have 6. So there's an enormous efficiency gain you get in terms of back office, just brute force that you need. And so you're always trying to manage your G&A expenses, right? They're not necessarily revenue generating, they're cash collecting, which is important. So they're essential, but you want to have that be as streamlined as possible. The third thing, I don't know, we sell the value. I don't think until you've been a CEO working with investors, you will not have felt this pain. When you're going through closing the books, your CFO, as good as they are, and their controller is probably going to spend 6 to 8 business days. So the first 2 weeks just closing the books. That's tracking the revenue. That's getting all the costs done. It's the output is your GAAP 3 financial statements, your balance sheet, P&L, and cash flow statements. And like that is critical. No one messes with the CFO for the first 8 to 10 days. In a normal company, then the CFO, he or she spends time looking at the operating metrics. Like, well, what happened with the revenue and what was the churn and where was the expansion and contraction? And that often takes another 8 or 10 days. So they're spending the next 2 weeks trying to figure out what the heck just happened. And I found in my previous companies that we would end up sliding into the board meeting with our hair on fire, hoping the analysis was right, but not having enough time to really dig into it. With a system like Maxio, like what is it, October 2nd, I can already tell you what my ARR and revenue is from September. I challenge people who don't have a system like Maxio to tell me when they're going to have insight into their ARR. I already know all my...
Maybe mid-month?
Yeah, well, not maybe
end of the month,
but it's mostly end of month.
Maybe.
So that
end of month. It's that's kind of typical.
Yeah, totally. So my opportunity now is my operating executive, my sales guy, and my head of customer success, and I can take the output from Maxio and be looking at it now. CFO is still closing the books. We've got a couple of weeks to kind of say, well, what happened here? And we launched these new pricing initiatives. Are we seeing them lead to more churn? Are we seeing better attach rates? So we have this opportunity to work on the business in parallel with the CFO closing. That, I don't know how valuable that is, but it saved me hundreds of hours of work and sleepless nights, and the numbers are right. And so when you go into the other thing I would say, and this is a sub point, is when you deal with investors, you're sitting across the table from Excel jocks. All these people do is work in Excel. You show up with a number that's a decimal point off, they'll catch you. And they'll say, hey, our last meeting, you said Q1 gross retention was 87.3% at the end of Q2. You come in at the end of Q3 and say Q1's gross retention was 84.5%, and they'll catch you. And they'll say, well, what happened? Why did those numbers change? It shouldn't have changed from Q1. And so then you go into what I call math camp. And the CFO has to open up the model. You're sitting in the board meeting. Everyone's freaking sweating because you're worried about the numbers. And as soon as the CFO has to open the model in a board meeting, you lost. You lost.
Yes.
You lost confidence. You lost trust. And so, again, how valuable it is to be able to walk in and deliver numbers that are consistent from month to month to quarter. It like immensely valuable for your investors if you're trying to raise money, manage investors going forward.
That's so good. And you're exactly right. I've been in those meetings and you get barbecued by the board.
Yeah.
Because the numbers weren't right or they changed or something happened. And what do you say to that?
Well, and that's
you just have the numbers that you had. And and
that's
not a good excuse.
And if you didn't catch it coming in, I do think there's opportunities. So let me give you an example. There's opportunities to change the representation of data. We were talking about usage-based pricing. There's arguments in the industry in terms of should you use the last month of usage multiplied by 12 for ARR? Should you use the trailing 12 months ARR? Should you use the trailing 3 months multiplied by 4? So 3 different methodologies to represent usage-based ARR. You coming in with a point of view on here it is with trailing 12 months, here it is with trailing 3 months, it gives you different answers. Let's talk about why it's different and which ones do we want to use going forward is totally fine.
Right.
But if you come in and you said your trailing 3 months was X and now it's X plus 4 and you don't know why, then to your point, you get barbecued. And it's an own goal, right? It's a self-inflicted wound. It's something like you want to spend time on strategy. You want to spend time on, should we open up a new office in this new region? Should we buy this company? And instead you're sitting there watching what can be excruciating, a CFO get eviscerated. I've seen people get fired because of board meetings. I tell my executive team, and when I wasn't CEO, I always wanted to be in the board meetings. I wanted to be in the inner circle. And I said, look, I've never seen anybody get promoted for what they said in the board meeting. I've seen people get fired for how they showed up in the board meeting. And so as CFO, you don't want there to be any, it's okay to be challenged, right? The assumptions, but you don't want to be caught. You don't want to have a gotcha that you've self-inflicted because your model wasn't right or someone fat fingered a sell, you didn't catch it.
And no surprises in the boardroom.
Yeah, right. Totally. And some people say that, and I 100% agree. What I don't think you need to have is the board meeting before the board meeting. What I try to do is I write at the end of every month. My team is working on it right now. Provides me some input, and it's a pretty long document. But I write an end of month summary. And I use our reports to talk about what happened with bookings, what happened with churn, what happened with attach. And so I send that out, I don't know, in 10 days. Again, because I have the Maxio report, I have all that revenue stuff as well, churn, contraction, expansion. I send that out. And so the board has that as a pre-read, an end of month summary. So I try to make the financials as surprise-free as possible. My CFO is great. He adds the comments around cash, and we're always talking about 13-week cash forecasts. And so if I, on the other side of the board, got that, I would, and I have been on the other side of the board, I like when CEOs provide that because I get a chance to process the data and the information before sitting in the board meeting. And if they give it to me a couple of days ahead of time, then I can come back with a couple of questions and say, gosh, in this segment, it looked like X, Y, and Z, or this product, it doesn't seem to be going. Like, help me better understand that. And for the management team, that's awesome because now you know what the board cares about. And so then you go into the board meeting having had a chance to think through a response to their questions, and you are not surprised in the meeting. So it's this mutual non-surprise agreement, right? Now, boards still reserve the right to ask any question they want, but I think most board members are not out to play gotcha with the management team. But I do think that if something doesn't make sense, it doesn't pass the sniff test, or their spidey sense starts to go off, they start to dig, and when they dig, then they start to peel. And as a management team, that's where you start to really worry, because if they find the fault line, they can go in and expose like the volcanic lava of chaos that's behind some number that you didn't really know. And it can turn into just, again, I call it breaking into jail. You're just like, oh God, why are we here? And, eject, get me out of here.
Well, I think that's one of the differences in a company that has a solution like Maxio, really has numbers dialed in.
Yeah.
And trying to do it through spreadsheets or manually. And it's the reason you don't have that report beforehand for the board is because it's not ready. And then it's right up until the last minute. It takes, 2 weeks or longer for the CFO to get that stuff together. And then they get it to you at last minute. Is it right? I hope so.
Yeah. And that's what I talk about.
And you walk in and walking in with hope is not good.
Yeah. Sliding into the board meeting with the hair on fire. And I will tell you, even at Maxio, what has happened, and it's my fault. All my team is great. I will send out the pre-read and the board will come back with some great questions. And now it's 48 hours until the board meeting, and I'm jamming the team to come up with answers to the questions. And we show up to the board meeting it's happened a couple of times where we didn't have a fully baked answer and we got blown up. And I was trying to get the A to respond to the question versus, so this is a lesson learned, versus acknowledging the ask. If it's easily available in terms of being able to represent the answer, providing that. And if not, having enough intestinal fortitude to say, it's a great question. We need to take that under consideration. We'll get back to you in a week or so with a response. And just having the patience to give the team a little time to dig in and for us to have some conversations. Because if they're asking the question and we hadn't covered it in our end of month report, we probably hadn't realized it was an issue or we hadn't looked at it closely. And so when I do that, I am just creating the context that I'm trying to avoid because I want to get the A to be, super responsive to the board and have all the answers. Yeah. And I think there's the better CEOs are the ones who are able to manage the board appropriately. And I think they would all be reasonable and say, that's fine. I just make sure you answer my question. What you can't do is say, I'm going to answer your question and then never come back to them. So you got to be able to manage the request and the response and close the loop.
That's real wisdom and just managing the board that way and not going in there feeling that kind of pressure that, I have to have this, get the A, get the 100% answer when it's an off the wall question. I've had that happen a few times and I'll get back to you. And it's like, well, if you don't have it readily available, if it's just curiosity, it's not something I really need. It's like, well, yeah, I guess it isn't important, or you find out it really is important and we need to start tracking this and haven't been.
Jeff, I think that's the other distinction that I just want to underscore is trying to clarify the ask of the board, understand how much work it's going to be for the team to produce, and then going back to the board and saying, hey, you asked this question, like, is this really a big deal for you? Because for our perspective, this is going to be a 40-hour work generator for us to answer that. And I think that's another place where a CEO can earn their chops and stripes and kind of respect from their executive team as they push back on the board's asks. Yes. And sometimes, look, I've been on the other side as a board member. I make asks and I will always try to preface it with, look, I'm not trying to generate work. I don't know how hard this is. However, it seems to me this is something we might want to look at. What do you think? And then hopefully give the CEO the out to say, well, one, we've looked at it before, it's not that material, or number two, it's a great question, but it really is probably not essential to what we need to do now. And so let's put it in the parking lot and come back to it at some other point. And I'm like, okay, that's fine. That's cool. So I think the board needs to help the CEO be successful there, but the CEO has also got to be managing that. And I would say, Jeff, when I think about the difference between PE and VC, is when you're only meeting once a quarter, there are fewer asks. When you're meeting every month, there are a lot of asks. And so I have a running list of board action items that we're trying to respond to now. They're good questions. They've helped us deepen our understanding of the business and think about how we can be successful. So I think there's value add, but it's like you have yet another set of executives on the team with you versus just your executives that you gotta manage.
So good. So good. Well, we've talked a little bit about acquisitions.
Yeah.
And it seems to me a lot of times companies the reason that one company sells is not the reason that a company buys.
Right.
And the value that they expect in that acquisition rarely works out. What are some of the key factors ensuring a smooth transition and then maximizing that value post-acquisition, whether you're on the buy side or the sell side?
That's a great question, Jeff. And I've had some experience here. I'm not a banker, and I'm not I've never been a part of a big company that's done 100 acquisitions, but I've both been part of teams that have been acquired, teams who've acquired. And then when I sold 2 companies, and at Percolate, I went on to Seismic to be the chief strategy officer and then led 3 investments, 2 of which were acquisitions. And then at Battery, part of the reason I came was because I wanted to be part of a organic and inorganic growth platform. And so we've been looking at acquisitions for the 2.5 years that I've been here. We put out, 4 or 5 LOIs. We just haven't been able to confirm and get one across the finish line yet. When you look at the research, I would say that people put a lot of time and energy into the investment thesis. And that's what the investors are usually doing. It's like what Chelsea and Dylan did for this space. They said, hey, bring these 2 things together. You go through some due diligence. It's primarily on customer due diligence in terms of the predictability of the revenue and generating EBITDA and the go-to-market motion, sales and marketing. I think what people underappreciate, and the research shows, is that 80% of acquisitions fail to deliver the value that was assumed in the strategy. It primarily comes down to culture, is what they talk about, is that there is 2 different ways of running the business, and you have 2 different executive teams. You have 2 different people located in different countries. And so if you aren't super deliberate about establishing a common culture and being clear about how you get the benefit of both and augment and extend and validate the acquiring company, you can lose a lot of talent in terms of the company being acquired because they were at a smaller company. They don't feel appreciated in the new company. They think the big company is old and slow. And so I think a lot of it comes down to culture. I think the other thing is integration and needing to have almost like an office of integration. So where you have someone who's very, very good at operations, process, systems, and data, because the value of the company will come from the ability of the 2 operations to come together across all functions. So let me give you an example. When Maxio came together in 2021, I don't think they had a great integration plan or a commitment to becoming one Maxio. So when I showed up a year later, we still had 2 Jira instances. We still had 2 Salesforce instances. We were still running 2 different email systems. You're not going to have the benefit and synergy of a combined go-to-market engine until you have the data collected in one system and one way of thinking about selling. On the software side, similarly, 2 different Jiras, 2 different support systems. We had one team that was primarily chat, one that was primarily email. So one of the first things I did when I came on was said, look, what we're going to focus on is one Maxio. We're going to go across every function and we're going to talk about what is the path to one Maxio and how do we reduce differences. Let's understand why there are differences and let's operate from what's best for the business in terms of what's going to be the most efficient or the most modern. What we ended up with Maxio, which was called an MOE, a merger of equals versus an acquisition. There wasn't like a big company. Like when I was at Seismic and Percolate came in, they basically said, okay, this is how we do things at Seismic. You need to make it work that way. And we said, okay.
Right.
But with an MOE, it's kind of like the Bloods and the Crips. Like, I don't know. There is no one right answer, but people are going to arm wrestle and say their way is the better way. And so until you had kind of someone like me who was Maxio first, and then the executives I've brought on since then are all Maxio first, we don't have a dog in the fight in terms of which Jira system we use or, whatever. What we want to do is just drive efficiency and effectiveness. So I think number one is having clarity of the investment thesis and just continuing to hammer that in your communication, your interactions with both teams, so that you're giving the reason why for the investment and what the future holds. Number two is being super sensitive to the culture and trying to create a merged culture that helps people feel valued and understand how they can make an impact. And number three is being really deliberate and intentional about the integration and having a senior person be responsible for and drive it on all functions, including the tech stack. So how do you bring the platforms together? Which platform are you going to solve for? Which one's going to be a module? How are they going to work together? How are you going to move to microservices? How are your SDLCs? Like all of that needs to be, you got to move that forward. And that is, the office of, sometimes it's called a PMO. But I think if you think that you're going to do M&A, you need to have that fall under a senior executive who's going to be responsible for doing every integration. And they're going to have a playbook and then roll it out. And that's going to start from the time you have a twinkle in your eye about there's an opportunity to put two companies together until you can, put the flag on the ground at the end and say, we won, the integration was successful.
Yes. So good. Well, you've been in multiple CEO roles, and one of the things you've developed is the 7 secrets of success for CEOs.
Yeah.
And you share those and why they're crucial for leaders, specifically in high-growth SaaS companies.
Sure. So I've been writing about it. One day I hope to get a book out. If people are interested, they can find me on LinkedIn. I've been doing several articles under the different elements. We talked about a lot of them, so I'll just run through them quickly. The first thing is the CEO, which is super clear, especially as a professional CEO, someone coming in a company where they've taken professional money, VCPE, you're playing with other people's money. And so you ultimately responsible for the results. And that results is defined as creating shareholder value. That you and your team need to understand, like, that's what you're being hired to do. So how do you translate what we were talking about earlier in terms of the exit expectations into the results that you need to deliver this year, this quarter, this month, this week, and just having the consistency there. Number two is establishing winning strategy. So the winning strategy, I love the book Playing to Win. I've used it at a couple different companies. It's awesome in terms of how do you think about what your aspiration is, where you're going to play, what are the capabilities you need to build. Highly recommend it. But whatever you use, having a strategy is essential. I'm forgetting the idea of, and I think it was Eisenhower or someone who said, look, the power of planning is not the plan itself, because that's going to fall apart as soon as you hit the beach. It is the practice of planning and thinking about what's possible and what are the challenges, how you can address them. So that's number two. Number three is all about culture. This is shaping the values and standards that will guide your company over time. I think this is even more important in hybrid work environments where you don't have the opportunity to connect with people and share culture and build connective tissue. So how do you build culture? One of the keys to that is building an effective executive team. Patrick Lencioni writes about this in his 5 dysfunctions of a team, and that executive team, the key distinction about an executive team is they got to move from being functional leaders to being business leaders, and they got to participate in conversation about what's for the best for the business. That may mean we take dollars out of marketing and put it in implementation. It may mean we take dollars out of engineering and give it to, HR. But you want the first team to make those decisions together, because then they got to go out and drive that broadly across their organizations and their functions with a clear understanding of why. We spent a bunch of time on number 5, which is managing your board of investors. So you set the correct kind of expectations. We'll talk about that. As part of that, number 6 is allocating capital to balance the yield today with the necessary investments in tomorrow. And why I bring that up is I think a lot of early stage companies are like, look, what I'm trying to do is get product market fit. I need my engineering team to build this next feature that this customer is screaming about. And so I would call that Horizon 1. You're trying to deliver revenue. You're trying to keep customers in the next 12 to 18 months. As you get bigger, after you pass that $10 million mark, you need to start to introduce Horizon 2 type bets. Those are the things that are going to generate revenue in the next 18 to 24 months. And so you got to balance capital. So one example at Maxio, we started with a payments product. It was a glint in the investors' eyes when I started. We moved a guy into it, wicked smart, Swiss Army knife type dude, can do anything. And we started to invest behind it. So then we had 10 engineers, product managers, engineers assigned to that business. And that's all they worked on. And that we're generating revenue from it. It's not nearly the revenue we're getting from our core business, but it will be a future revenue driver. But having that capital allocated on a 2 to 3 year time horizon versus I need this payback this year is a different way of thinking about capital allocation. And as you get bigger, Horizon 1, Horizon 2, Horizon 3 investments, you got to ring fence them. You got to set them up, define success for them differently. But it's wicked important. And then I don't know how much time we got, but I have two more. One is investing in your tribe. And the other one is unlock the potential of your people. What do you want to pick on one of those or wrap it here, Jeff? What would work for you?
Oh, let's talk about the last one.
So this
is investing in your people.
Yeah. So, this is interesting. So I had 7 and then I had 2 people who used to work for me at Microsoft a long time ago, wonderful people who run their own HR consulting firm, come on my podcast, and they were advocating for this 8th point. And I was like, no, I want 7 because it's alliteration. It's 7 secrets of success, 7 skills of hire the people, all that stuff. And they absolutely nailed it. Was that, ultimately your job as a leader is to unlock the potential of your people. How do you get in and understand? And it's super interesting. I just did a conversation with this guy, Mark Tressler from Leader Software, great guy. And he was talking about this as well in terms of the different generations and the expectations for a millennial versus a Gen Z versus a Gen X and how to manage and deal with them. And it's just very, very different. And if you don't spend time thinking about that and creating programs and communication, engagement, they'll go someplace else. Software at the end of the day is a people business. That's it.
It is.
We're not, I'm not making bottles or creating books. Like it's taking IP, converting it into technology that people access through the interweb. And you got a bunch of people that are helping. And so if you're not able to unlock their potential, it's going to be super expensive as you try to go out and find new candidates, get them to fleet up. It takes them a year or 2 to get fleeted up. So I think that was a really great add to my 7 secrets. So now it's 8 secrets.
I love that. Where can people learn more about you and about Maxio online?
Well, LinkedIn I'd love for you to follow. I'm producing a bunch of content. Like you, all the cool kids have I've learned all have podcasts. So I've got the SaaS expert voices. I think only my mom listens to it. So if your listeners would at least click on it, that would be super helpful.
Yes, do that.
They can come. We've got a whole bunch of information about SaaS and how to run SaaS companies at Maxio.com. Under our resources, we have a thing called SaaSpedia, which defines all the metrics. So if you're new to SaaS or want to try to figure out what new CAC versus expansion CAC versus LTV to CAC means and the nuances. We've got all sorts of tutorials there. We've got blogs. And so that's a great place. That's also where you can find, under resources, you'll find the growth report, which you can download for free. So,
yes.
And then finally, Jeff, look, I'm like you, I've really enjoyed our conversations and interactions. I'm always willing to chat with someone. So if they want to reach out at randy.wootton, which is WOOTTON at maxio.com. I'm always happy to make 15 or 20 minutes to chat about something they're wrestling with, some idea they have. If you're going to pitch me your product, okay, but take that next step to figure out why I really need your product. I'll take the pitch, but because recovering salesperson, I have a lot of empathy
I do too.
For those that are trying to get the damn cold call. But just don't pitch me. Be smart. Come in with a look at my website, look at my profile, come up with a new idea that I may not have thought about, and let's have a good, productive conversation about it.
Outstanding. And everybody should definitely follow Randy on LinkedIn. Such great content, and definitely get that Maxio report. So much value there. And like I said, I can't believe it's free because it is so valuable.
Yeah, well, one day, hopefully we'll have people clamoring for it and we can charge. But thanks so much for your time, Jeff. I really appreciate it.
Absolutely. Thank you for being on SaaS Fuel. It's an absolutely fantastic conversation. Thanks again, Randy, for coming on the show and sharing your journey and insights. I really appreciate the depth of experience and willingness to share it all. You can learn more about Randy and Maxio at maxio.com. And be sure to check him out on social as well. Great posts on LinkedIn. As always, all links, highlights, resources, and full show notes are available at saasfuel.com, and be sure to check out our YouTube channel as well. Full episodes, video shorts, training, some outtakes, lots of stuff out there for you. The thought leaders share. Share this episode with a leader you know who may wear too many hats in their business. It's kind of all of us sometimes. Everyone who shares this week gets a Fusion formula flask. Drop in 2 great ideas, shake it up, and stand back as the reaction sends your results skyrocketing, because 1 + 1 equals, say it all together now, 7. Join us next Thursday on our SaaS Fuel Expert Series, where my guest is Naomi Soman, master marketing storyteller and weaver of irresistible true tales. She'll be with us to talk about how to craft your superhero origin story so that ideal clients want to help you conquer the market. Avengers Assemble. And then next Tuesday, we have founder Brian Parks, founder and CEO of Bigfoot Capital, as he shares how he's helped over 50 SaaS companies achieve $1 billion in enterprise value through non-dilutive growth capital. And of course, his own journey as a SaaS operator and investor to a 9-figure exit. We'll see you next time, and as always, enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at saasfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSfuel. We'll be sure to read these out on future episodes.